All right, folks. So I have a good friend of mine, Amar Shah, who just about 3 months ago started his own firm in San Diego. And the website is clientfirstcap.com, clientfirstcap.com. And I've been working with Amar for a long, long time. So he's a good friend. It's exciting to be able to bring him to the Josh Scanlon podcast. So welcome aboard, Amar.
Thank you, Josh. I'm excited.
Yeah, absolutely. Absolutely. So, Amar and I, as I said in the introduction, worked at USA for a long time. And Amar, what made you, think about going into starting your own firm? It's a big leap with young kids and everything. So what was the genesis of doing all this?
Yeah. So, I was a lifer at USAA. And so to take this change really came down to two things. One is my dad passed away in 2017. And I realized, even though I was a financial advisor and my parents had everything, there was a better way to do this. There's a better way to organize everything. To give you an example, like their documents now were paperless, and it's been 2 years, and we're still finding accounts that my folks had that that we didn't know about. And so I thought, for my member base, that there was a better way to do this, and I wanted to create it. And so that's why I left USAA.
So going back to your dad dying, the estate is still being settled? Is that what I'm hearing?
No. So now it's all settled. But
okay.
Originally, there was a couple of accounts, and then my dad did a little bit of teaching at the local university here. And he had a 403B plan there that my mom didn't know about. I didn't know about. Yeah, so it's kind of like popcorn. Like we find these things after the fact.
That's that's interesting. When my wife's mom died, this is in 2006, and 2006. That's when I realized financial planning, i.e., is more than just investment management. You know what I'm saying? Because the investment stuff is simple relative to all the other crap you got to go through.
Yeah, exactly. And so, like, when you're an employee of a big firm like USA, you have to stay in your lane and focus just on the investments and retirement planning.
Right.
But what I realized, going through this life event with my mom is, like, you make investment decisions. Obviously, there's a tax impact, right? And I should be able to have that conversation. And there's also a estate planning impact. And so I kind of wanted to be full transparency, holistic advice, not just on investments, not just on financial planning, but also tax planning, estate planning, executive compensation. I mean, there's so many different areas that have impact. And it's like this convoluted web that you really need one person to kind of oversee and make sure all the pieces of the puzzle are fitting together. And so I just realized, I came to the realization that I couldn't really do that at a big firm.
Not and provide individual advice. That's my contention with all these big firms. It's just impossible for individual advice to be given, because they have to, there's got to be a flow that they can make sure there's no fly-by-night guy, that's running rampant. There has to be some kind of stringent control over all the advice that's given, or else the big firm essentially could be sued. I mean, it's just all there is to it. It's I think that's actually a bad thing, frankly, where these big firms are, holding themselves out as offering comprehensive wealth management, and you and I know that's just simply can't be true.
Yeah, and big firms are built for scale, right?
Exactly.
So they have the name brand.
Yep.
They can create a couple models, and then they can have these advisors to gather assets, and then just scale this business. And what I'm trying to do, what I came to the realization, is that when you have wealth, you need to have a comprehensive plan, and something that has scale is not going to be individualized. It's not going to be tailored to you.
Right.
And our industry is going through a shift, kind of like when TurboTax came out, and you have CPAs, and now you have TurboTax. Well, in our industry, it's if you have assets and you're fairly simple and there's not much complexity, these firms are great.
Right.
But they're the lowest cost provider. But if you want something tailored to you, something customized to your tax schedule, etc., I mean, you can't do that in a big firm because they're built for scale and simplicity. Whereas we take a different look at things, trying to factor in taxes and everything else.
Well, and the irony of it all, though, is they still charge as if they're not scaling you up as a client. They're still charging you for the individual tailored advice, even though we know that's simply not happening because, like you just said, they're built for scale. I mean, there are some firms, Vanguard comes to mind, that will charge you, for their scale because they're owned by their employees or their shareholders. But these other firms, there's no way they can tailor advice specific to you because they're built for scale. That's all there is to it. You know what I'm saying, Amar? I always chuckle when I see these, like, we build, structured, tailored solutions. Like, you really don't.
Yeah, I mean, you see the commercials, and then you see these advisors. I mean, I'm guilty of it too because I was an advisor at a big firm for several years. I think it was like over 8 years with USAA. But what I'm trying to say is that, I mean, I had over 200 clients. Right. I mean, there's no way you can customize solutions for 200 clients and stay on top of all that. It's just not feasible. And I talked to a buddy of mine who works at another firm. I mean, he's got close to 600 clients. I mean, how's he effectively meeting with all those clients, doing all it just blows my mind.
No, that's not to get too deep in this because I want to talk about what you're doing, but that's my biggest frustration with the industry is that all these guys have been saying commission-based people are the worst, and then we have the exact opposite of commission-based. Now we have what's called reverse churning. I'm sorry, if you got 600 clients and you're charging fees for asset management, you aren't doing the.
All right, so Amar, the issue with, again, the reverse churning thing is, I think, something that bothers me about the industry, and I don't want to spend a whole lot of time talking about that, but it is a problem, and I'm glad to see that more and more advisors are doing what you're doing, which is starting your own firm. So, nerve-wracking, is it not, to be self-employed, an entrepreneur? I mean, how are you feeling after 3 months in the business?
Yeah, I'm incredibly blessed. A lot of my clients found me. A lot of my networks in the area saw what I was doing and said, this is amazing. And I got really lucky that I had a good start. I'm also really lucky that my wife works, so we never had stress of finances or anything like that. And so I really could build this right. And I've also come to the realization I'm never going to be the advisor that has 1,000 clients or 100 clients, so I think I'll always have less than 100 clients. So, slow and steady, and going deep with each one of those clients is really what I'm looking after. So, I don't need to grow like you do in a big firm, right? You don't have to get, 20 new clients each year and stuff like that. I mean, yeah. So I feel really blessed.
Well, I think that's interesting about the your wife working and taking some of the burden off of having to land everybody who shows up at your door, because that is one of the areas of our industry that has really, I think, another area that really stinks is that maybe people do a little bit of over promising, under delivering, when they could just say to people, hey, you're going to be okay, and just keep doing what you're doing and just move on. So when you have the ability to kind of pick and choose who you want to work with over essentially the course of the rest of your life, for an advisor, that's a good place to be. You know what I mean, Amar? Because you can say, I'm not to a client, a prospect, we're not going to be a good fit for whatever reason it is. You don't have to take everybody.
Yeah. And look, I'm under 40. Right. This is going to be the rest of my life. This is my, the next 30 years of working is, I want to work with people that I enjoy working with and that I actually can have an impact. Right. If I can't have an impact, I mean, it's really hard to sleep at night justifying that you're charging a fee and you're really not doing much. And so, you're right. I get to filter, and that filter provides me peace of mind and more enjoyment and comfort around what I do as an advisor.
Well, given that you're under 40, you have any issues with people saying, Amar, you're too young, you don't know anything? I mean, what how's that shaken up for you over the last few years?
Josh, I'm like Goldilocks. I'm like Goldilocks. I'm not too young. I'm not too old.
Right.
I'm not inexperienced. I'm not too experienced and really focused only on one thing.
Right.
Like your PhD versus your generalist. And so it's actually been my biggest selling point. So my target market are individuals that are older than 65. And, when you're going into retirement, you don't want your advisor to retire while you're in retirement. I mean, it's kind of like most of my clients, their doctors are retiring, right? So the average age of my member is 74. And now they're looking for, all right, who's going to be my cardiologist for the next 20 years or 30 years, So it's you got to find somebody that has the experience and the education, but that's also young enough to be with you when you need it most, when you're in your 80s. And so what I found is that for clients, as they get older, it's harder to find people that they trust. I mean, and so my target in terms of working with the clients that I work with love the fact that I'm under 40. I mean, it's like, that's the reason that they're working with me, so that, if it's husband and wife and one spouse passes on, they know their spouse is going to be working with the same person. And since I'm comprehensive, I know everything and how everything fits together, and I make it easy for that surviving spouse.
That is so critical. I can't tell you how many people in my own career said, my advisor of 25, 30 years, he's older than me, and now I got to find somebody new because while I think we're squared away, I'm worried about my surviving spouse or my kids or something like that. And I want it to be a smooth transition from advisor A to advisor B. I actually think that's a huge benefit, and also being a little bit younger than the average advisor, because the average advisor is 55 years old, folks. I mean, the average advisor isn't a spring chicken, him or herself. But a lot of those average advisors came up through the business when it was a different model than we are today, which, again, today is we're all focused on comprehensive financial planning. And that might sound cliched, but it really means something. Just like when we started this interview, Amar talked about, having to deal with the estate planning and everything. This is a new realm of true financial planning, more so than just investments. So, Amar, okay, that's great, but you've been in the business a while, but you're not just a certified financial planner. You're a CFA as well. And my research from a few years back, I'm sure it's the same thing, is only like 2% of CFPs had the CFA designation as well. I don't know if that's still true, but why'd you decide CFA is a freaking hard thing to do, a whole lot harder than CFP. So what made you think about going and becoming all that educated in terms of various areas of the financial planning realm?
Yeah, I mean, so let's step back and just talk about how I got into financial planning. So my degree's in electrical engineering and computer science. So I'm not your typical advisor, right? I came up through the world of financial planning kind of by a career shift that I had. So I got into financial planning because my job when I was working at Qualcomm down here in San Diego got outsourced to India, and I'm Indian. So I was like, what's going on with that? And so like I made a decision at that point that I want to work with people, and working with people is you have to have a different set of skill set. And so when I got into financial planning, I actually failed. And it's because I wasn't listening to my clients. I wasn't understanding what their needs were. I was just trying to, these are your problems. This is the solution. And as most engineers know, That's something that we get harped on quite a bit. So I stepped back and worked on my listening skills, and I'm not the best person at really identifying, but I've gotten good enough to the point where I can understand clients' problems. I can also articulate, why these are concerns for a client, and then I can go back to being the watchmaker. Now, the CFA specifically is with security selection, investments, estate planning, calculating what's a residual gift. And so I wanted to, if this was going to be my career, I made a decision at USA. This is what I'm going to do for the rest of my life. Well, I really have to invest in myself to make sure that I'm the best possible advisor for my clients, right? And so I said, well, if I'm working with individuals that have significant money, like who do they trust? And I came across the CFA, and most of these larger teams that you see in Barron's Top 100, they all have CFAs on their staff. And so I said, well, how cool would it be for the end client to work directly with the watchmaker? Instead of working with the relationship manager, you have the person that's building your scenario out, and that's kind of how I got down the path of getting the CFA, and kind of how I use it in my practices. I am the watchmaker, so if we want to figure things out, I'm the guy that you want to talk to in terms of figuring it out. And so it's been good for me.
So you're not just sending the watchmaking skills, the components of actually full-fledged financial planning and investment management. You're not just sending that to third-party people. You're actually rolling up your sleeves and doing it right there in house. Yeah.
So let's talk about this for a little bit. So most people work with an advisor. The advisor gathers the data, and then they have a financial planner in their back office, or they have an investment manager in their back office, and that's what they do full time, right? And
exactly.
What I realized is that model is good for scale. However, if you're looking to say, well, this is my portfolio model and we have this taxable event, I don't want to sell anything in my portfolio. Well, you can't put those restrictions as easily on that model, right? Because the right hand is not talking to the left hand.
Yeah,
and so I said, if I want to create a tailored solution, for like my mom or for any client, the right hand has to talk to the left hand, and that's not a scalable business. And so, me doing the financial plan, I also use tax planning software, so we can model out 5 years worth of taxes to see what the next 5 years are going to look like, when we should do Roth conversions, when should we not, when should we gift assets, when should we, these are all correlated decisions, right? And so really digging into the financial planning and investments and taxes together is how I create a holistic solution.
And not only that, but like the gifting of assets too, it's more complex than just, I'm going to give you 100 shares of XYZ stock. There's got to be, there's got to be more involved in that because of things like cost basis and just all that stuff that goes with it. And just it still to this day boggles my mind how many financial advisors are just ignorant of the complexity of true financial planning, and they make it seem like it's just turning investment management over to Vanguard or something like that. And there's just so much more detail than that, for sure. And I guess that's one of the benefits of having you have a degree in electric engineering.
Yeah, computer engineering. It's half electrical engineering and computer science. So,
well, it's funny because a lot of my folks who watch my YouTube channel, Amar, are engineers, and one of the reasons they like what I do is I do a lot of spreadsheets, and they love the concept of spreadsheets and analysis and if this then that kind of stuff. And it's interesting to me. And I always tell them, I said, we actually need more engineering types in the business. Not engineering types who think I know it all, but engineering, not me, but engineering types who who know everything. But engineering types who, kind of like what you were saying, have the ability to relate to people, but can also dig deep into the the intricacies of the various plannings, because it is like a puzzle. And I think more and more engineering folks would find that the puzzle, well, it can never be solved explicitly because we don't know the end game of a client in terms of when they're going to die and things of that nature. But you can come pretty close to get a pretty good puzzle established. But I think it takes an engineering mind, actually, a mindset, an accountant's mindset, something like that, to be able to put one together to get two, as opposed to like, just throw it together in this, mash of a salad, so to speak. So I'm sure that's helped you immensely in your career.
Yeah, and I think that's happening. So like if we look at the evolution of our industry, I mean, when it was just like Wall Street and you had your wirehouses, the wirehouses had like XYZ stock that we have to sell to all your clients, right? We have to unload the stock to investors, right? You have these big wirehouses that buy big blocks of stocks or bonds, and then they underwrite these bonds and then they sell it to their investors. And so the type of person you need for that role was somebody that had business background or sales or communication or a lot more people skills, where it's like, hey, I got this hot stock for you. It's trading at a discount, or we just underwrote this bond, and we're giving, it's a new issue to our clients. And that's how the industry was, 30 years ago. I mean, some of my clients still think that that's what they want from me, which now the industry is going more towards comprehensive planning, which you mentioned earlier. But really, it's like, how do I take all these pieces of the puzzle and make them fit together? Well, that takes a problem-solving type mindset, which, like you're mentioning, is engineering. But, I mean, we're only 3 years into this comprehensive financial planning shift, if you will, right? Yeah.
Tell us a little bit about your firefighting experience. So you shared with that story offline, but I thought it was interesting. I figured I'd just ask you if you don't mind sharing. I thought people would find that kind of unique, actually.
Yeah, so now we're going really far back. So,
well, people need to know you, man. They need to know you.
Yeah, so I was a volunteer firefighter throughout high school, and then I worked for a little city out in San Diego called Poway, a small city, and they had the part-time reserve firefighter. Was basically the fourth person that was on the rig. Would you work 2 or 3 shifts a month? And so, like, growing up, we relied on 911, the paramedics, firefighters a lot because of my dad's health. And, I always thought that's what I wanted to do. And, as soon as I graduated high school, I applied to be a full-time firefighter in the city of Poway, where I was working already. I knew the captain, knew everybody. And I sat down and basically in the interview process, the captain told me that, like, hey, look, we're not going to hire you. You're too young. You're too smart. You should go to college. And so, I became an engineer and then became a financial advisor. But, at the heart of it, helping people is my why. Why do you do financial planning? Well, there's 3 reasons why I do financial planning. I love helping people. Like, my wife and I, and now my daughter, we volunteer quite a bit. Being a financial advisor allows me to continuously learn, because tax code changes, estate planning code changes, investments. Just look at investments changing. Before, we always had, Schiller and all those models where you look at, cost of goods and all those other factors in investments. Well, now you have all these internet companies that have no inventory, right? Yeah. and so, I love to continuously learn, and be part of that. And lastly, being an advisor also provides me with work-life flexibility, which is important to me. You're talking to somebody whose dad passed away at 64, right? I want to also be able to enjoy time, with my kids and do other things. I'm okay working to 70 as long as that I have some freedom to do what I want when I want throughout that journey. Um, yeah, and that's why when I was at USAA, I was like, wow, this is awesome. I'm gonna do this for the rest of my life. And then as I continuously learned about our industry, I was like, wait, there's a better way to do this.
Yes, that's
yeah.
the epiphany.
So,
you have the epiphany. You say, wait a second. Well, USA is better than most. There's still even a better way, and the only way to realize that is just break free. I mean, it's literally it's that simple, and it's scary. It's scary breaking free from the tried and true, where they pay decent for doing what they tell you to do. It's scary.
Yeah. But it's all worked out, and now that's all in the past.
Now, so I'm just curious. You mentioned about the no inventory. I actually did a video this morning about value versus growth, and I frankly don't care all that much about who thinks what. But I am curious about that because one of the things with Amazon, this is more stock. It just occurred to me, and I'm interested to ask you. They don't have. There is no earnings relative to the prices. You know what I'm saying? And so yet everyone and their mom thinks, and I don't know. I don't know the answer to this, but just given what you just said there, there used to be an inventory. They got to rebuild the inventory. There's all that stuff, and now it's just it's a whole different dynamic in how you value stocks anymore. It's interesting to me in a way that, again, not for where I make my investment decisions because I just have the market. I'm done with it, but. I don't know. Any thoughts on valuations? I mean, everyone, going back to Schiller, I mean, everyone says valuations are always key for future performance. I mean, maybe it's not true anymore. I don't know. You have any thoughts on that?
Yeah. I mean, and when I was saying no inventory, I was talking about companies like Google, Facebook, Uber, right? I mean, they have no inventory. They're just, here's what my thoughts are. We got to find the right allocation mix to protect on the downside and get as much upside as potential as possible. And so I mainly use index funds and individual bonds to get that type of an exposure. What I would relate it to is that the markets are kind of like walking a dog, like you can walk in a straight line, but Fido is going all over, right? And eventually you guys both get to the same place, but one took a bumpier ride or all over the place, and one was a straight line. And so the idea that you can price securities accurately,
right,
based off these equations, I think you can get maybe 95%, 90% accuracy, but I don't think you can get 100% accuracy. And what provides the most amount of accuracy is liquidity in the market. So if you look at like Vanguard's large cap fund, it's evading me right now. I think it's VVO or whatever. But just look at a large cap index and look at a large cap mutual fund. I mean, there's the trading volume is so high. It is very hard to say that you can create alpha year in, year out and justify that fee that most funds charge. So
that's a great analogy too of walking the dog. That's a great analogy. Yeah, because Fido is going all over the place. He's going behind you. He's wrapping his leash around your legs.
Yeah, and so like in those situations, right? It's controlling behavior, right? Controlling what can we control is how we react to those, right? And so, my focus has always been and tries to be on controlling behavior, and behavior is really a function of downside exposure, right? So if we can wrap our hands around downside exposure, I mean, really, we can find the ideal asset mix in terms of asset classes, and then we can base, our planning around that.
Well, I think the individual bond thing is actually pretty critical. Actually, I've always been a fan of individual bonds as opposed to funds, because the individual bond, as long as the issuer doesn't go kaput, for a fact what your rates of return are going to be. I mean, there's just no other way around that. You will get X, Y, Z for a rate of return, and then you fast forward to the maturity date, you're going to get your money back. And I think as a foundational approach. Now, I don't like bonds generally speaking, Amar. I don't think there's much value there. But for a long-term investment, who's somebody's about ready to retire, laying the foundation on individual bonds as opposed to a mutual fund, which never has a maturity date. I think a lot of investors make that mistake horrifically. Actually, I think they're too keen on mutual funds and ETFs on the bond side, and not nearly looking at individual bonds. So now, can you buy individual bonds in the market? Does your firm, your custodian offer? I mean, how do you actually get your individual bonds for your clients' portfolios?
Yeah, so we use Fidelity as a custodian, and Fidelity has a bond desk where I can go and buy bonds. And there are three types of bonds that we can buy. We can buy new issues, right? So there's no spread, there's no markup or anything else like that. We can buy odd lots, which is basically, let's say Fidelity buys like $100 million worth of a bond, and then they sell, 80 million to another institutional investor, where that 20 million is what's called as an odd lot, and they go to retail investors, and you can purchase those. Usually those are the best opportunities because you're getting an institutional pricing. And then we can go to the secondary market and just buy, look what's out there.
Yeah.
And so,
keep going.
Yeah. And so, I mean, those are the three avenues that we have. And kind of when you're buying a bond, I mean, there's more than just two factors, right? I look at bonds as IOUs, right? And, there's credit quality, there's how long you want to have this duration, or time of maturity. And, in this all-time low interest rate, historically speaking, paying 30 to 70 basis points for a bond mutual fund is very hard to swallow. And these bond managers, when interest, what I think clients don't understand is that when there's fluctuations and other clients are getting out, that bond manager has to stay true to that prospectus that they all signed and sent out to everybody. And that prospectus may, say you have to keep X amount of cash. And if you have to keep X amount of cash and things are going down, the only thing that's worth selling is your best investment. So, I've had people tell me, well, I'm just going to buy and hold like the Vanguard long intermediate tax exempt bond fund. But during volatile periods, the credit quality of that is going down. And to get extra yield to maintain a stability for the clients that are in there, I mean, they're going to take extra risk. And that could be investing in bonds that are municipalities that are backing them, like oil and gas. Or it could be, private, like stadiums and stuff like that, like private issue bonds, but that are backed by a municipality. So I just think there's more transparency in owning individual bonds because you know what you have, you know when it's going to mature, you know what your yield to maturity is. The credit risk on most municipalities is less than 2%. And so, yeah, I strongly believe in individual bonds, at least being a portion of your.
Then the mutual fund manager, I mean, think about from a pension perspective or insurance company perspective, these guys own just so much in bonds, and yet, their charter is a lot of these guys can't own bonds that are downgraded. They got to be, investment grade. And the minute a bond is downgraded to below investment grade, it has to be sold. And yet, even if the bond itself was doing just fine, the issuer, in terms of his ability to stay put, that's the issue too with mutual funds is that, like you said, the prospectus or the charter, however, the minute the bond has a change in ratings means it could be liquidated, and you're like, that bond. There's no reason for that bond to be liquidated, and thus causing a lot of times a tax consequence if on the upside or a freaking loss on the down, and that's a problem with those bond funds, especially index funds on bonds, because there's so much, like the Vanguard it's 70% treasury, essentially. I mean, so you're buying a government bond fund, and yeah, I know you're not paying much money for it, but you're not getting much back. And unfortunately, Amar, a lot of these guys will charge people on the bond funds plus the expense ratio on the funds as well. So when all said and done, you're losing essentially half of your return because of their fee. Whereas at least in an individual bond, you know what you're getting. You know what I'm saying? I've always been a big fan of individual bonds.
Yeah, I mean, I got a funny one for you. I came across somebody. Their advisor was charging 1%.
Yeah.
That counts, under $1 million. And they were in a bond fund that had a fee of 0.68. So they're paying 1.68 all in, and their yield to worst, which is, if you have any calls or anything like that, the yield to call or yield to worst was 2.5%.
Oh.
So really, they're making 1.5%. Like, worst case scenario, they're making 1.5%, if that. Like less than 1% is what I'm trying to say.
Right.
But yeah, it just didn't make sense. Doesn't make sense.
It might just being CDs at that point. You know what I mean? I mean, my goodness, what's the point?
I mean, yeah, you get principal protection in a CD, right? Like, you have no downside.
Exactly.
I mean,
so how do you?
curious,
how do you bill? I mean, that's a great question. But so, I mean, obviously you're not doing this for a charity, so you gotta get paid. How is it? And just folks, what I like about Amar's website is it tells you his fees right up front on the website, and that's what I'll never ever recommend somebody who doesn't disclose their fees on the front end. I actually had a conversation with a guy the other day, Amar. He goes, we are ADV, and folks, that's what you register with the SEC, what your fee schedule is. And I said, your fee schedule is whatever it was. He goes, no, that's what's negotiable. I said, so basically no one knows what the fee's going to get. You're going to charge them until you negotiate with them. I said, what's the point? I don't know. Anyway, so tell us about your fee structure, Amar. I think it's important for folks to understand because it's good.
Yeah, thanks. Yeah, I mean, again, going back to my mom, right? What would I be okay with my mom having? And I basically have two options, right? Where it's advice only, where I just charge a fee based off of complexity, the time I'll need to solve, the problem, as well as the time needed to service the account for like a year.
Yeah.
And then I have for individuals that have, want somebody to actually implement and to move forward, I have an AUM fee, and my AUM fee is black and white. It's on my website. It's clear as day. There's no negotiating. There's no debating. It's right there, black and white. And you can go on the website and see it. But essentially, it's for $1 million or less, it's 75 basis points, and then it goes to 50 basis points, and so on and so forth. And I wanted full transparency. So this fee is the fee to have me, right? There's no other fees included in this. I don't get any kickbacks. I don't get any commissions, spreads, any other sorts of monetary compensation from anybody, right? Like, the only way I make money is based off this fee schedule. And, let's say if we're buying a stock or something, well, Fidelity charges me $4.95 a trade, and that $4.95 a trade I pass through to the client. So in some circumstances, there could be maybe another $100 for ticket charges, but other than that, it's just this fee.
Yeah, that's pretty good, and that way there's no negotiating. People know exactly what you're getting. Whereas a lot of these other firms, you just don't know. In fact, Mar, I don't know if I ever told you this, but I did a study, quote unquote, with some folks on my YouTube channel. We looked at about 100 different websites on advisors from NAPA. I forgot what NAPA stands for, but it's a fee-only firm, group of people, personal financial advisors. And I think only 2% actually had their fees disclosed. That was easy to find, and I was. NAPA is supposed to be the purest of the pure. I was amazed at how few people actually put their fees on there. it boggles the mind. And again, it sounds like I'm negative on the industry, and I am, because it could be so much better with just some basic tweaks, doing what you're doing, disclosing your fees up front. That way, if people say it's too expensive, they don't waste anybody's time. It's okay. But a lot of people need your service, and my service. They need to have financial planning. They need it. Just going back to what you said about your dad, what happened with my wife's mom, trying to settle that estate. All that stuff's a friggin' pain in the butt. You know what I'm saying? And you just need someone to be able to walk you through it beforehand, because if not, it could be it could be a headache that could have easily been avoided. It's more than just estate planning. It's more than just taxes. It's having one person or a team that you can go to and say, I need to make sure this is done and done correctly. And not,
this is how it's all coordinated. I mean, I use the analogy of an event planner, right? Like, we all can throw a good party. Like, I barbecue and we can do everything great. But when you're not there, or if you're in a stressful situation, you need somebody to step in and say, like, hey, these are the things that we need to do. This is how we do it. And that's why there's a profession that's called event planners, right? Like, at a wedding, you're not going to be the person to tell the caterer to move the food and stuff like that. I mean, that's why there's this whole industry, is that, you need a professional to step in to say, all right, this is how we're going to do it. And I should mention is that, we also do trustee services, and we work with Fidelity as a corporate trustee for individuals that don't have, or, they don't want their kids involved. They don't want other family members involved, and they just want everything done appropriately. We do trustee services. We can do the principal and interest calculation. We can prepare all the. I mean, I'll give you an example. So one of my clients, significant wealth, husband passed away. Wife is left there with 3 irrevocable trusts. And she's asking me, like, well, how do I know how much I have to distribute? Well, you have to read the terms of the trust. And the trust terms say only interest. All interest must be paid. Well, how do you calculate that? Some of the dollars are not being reinvested. There's tools to get that done.
Actually, I think that's pretty important for people to understand, is that when it comes to this kind of stuff, that Fidelity is offering to, and Amar's affiliated with Fidelity, but the old days of, it's interesting how much things have changed over the last just literally 5 years in terms of the complexity of financial planning, and you can't just set it. I hate to say it, but you just can't anymore set it and forget it. The technology is so smooth nowadays that what used to take hours and a huge expense to figure out the difference between principal and income on a trust account it doesn't take that long. And yet, if you're still paying significant fees, as a lot of trust accounts are, based on that premise, a lot of times it's just not worth it. I mean, each situation is different, but there's no reason to just say, well, that's what I've always paid, I'll continue to do so, because the technology it's opened up a lot of doors for efficiency, that's for sure.
Yeah, and like, if you're looking at trustee services, like, if you look at a bank, like, a bank won't hold any real estate. So, like, mom and dad have this house that they've lived in for 30, 50 years, kids want to keep it, but the banks, if you have a bank listed as a corporate trustee, the bank can't hold real estate. So they'll force a sale of mom and dad's house to put that money into their investment models, which they get paid on. And then if you go to an attorney, well, there's a conflict of interest, because you're going to need an attorney and you're going to need a trustee. And like, California has caught on to this. And in California, an attorney can't serve as a trustee, or they have to disclose to the client their separate billings for, you can't charge on both, being an attorney and being a trustee. That doesn't work in some states. And so I really think the role of a financial advisor or wealth manager, to be that holistic person, is going to be more and more, because if you look at CPAs, they're doing all these tax returns, through January through April, and then quarterly taxes. So they got enough on their plate. Attorneys, they don't see your actual investments, and banks are actually going to sell all your investments and force you into their model. So I think, we're seeing this comprehensive planning with the baby boom generation. I think the next phase is you're going to see wealth managers providing trustee services. And I think that's the next wave.
That's such a great point about because accountants, I know my wife works at a CPA firm now, and the slow time is in the right now. The summertime's slow. Right in September, right before extensions are hugely busy. Obviously, end of year stuff is busy, and then obviously the beginning of the year is crazy busy. But they're always reactive, and they just don't have the capacity to be proactive with their clients. And that's not saying all of them. I'm not saying that, but I'm just saying when you think about it from an accountant's perspective, man, they are. I'm just telling you, they're busy as double hockey stick when the deadlines are. They don't have the time to be calling you up and say, hey. And attorneys, like you said, they essentially they're not going to do that when it comes to asset management because they can't touch that with a 10-foot pole. Now they might have, they might work with firms that do that. I don't know, but again, they're limited in that regard. And banks, come on, let's not be silly here. I mean, a bank knows what the bank's there to do, which is increase their profits for sure. So it's not just trustee accounts though, but it's the whole thing where the overall. I want one team who can help me coordinate with my accountant, my lawyer, the whole thing. And that's, I think that's a value added big time.
Yeah. And, I'll give you an example is that, there's a thing called a grantor retained annuity trust. And essentially you put stuff in there that you think is going to appreciate in value. And then all that appreciation is on your beneficiary side of the balance sheet. And then you have a term for it, right? So most attorneys will set it up, and at the end of the term, they'll send you a reminder like, hey, do you want to do another one, right? But between that term, that security that you put in there could have gone up in value, could have gone down in value, right? Yeah. So the only person that's actually looking at the values of all these individual holdings is your wealth manager. I mean, that's why I think being a wealth manager in the next 2 decades is really going to be game changing. It's kind of like when TurboTax came out and CPAs had to, kind of change what they do. I think our industry will go through the same.
Oh man, well, I'm glad you're there to be there to benefit from that because again, you're a friend of mine, folks. So I mean, don't take this wrong. I mean, Amar's my man and all, but I just, implicitly, he's a guy who knows what he's doing. His fees are absolutely reasonable. I would not, obviously I can't make specific recommendations, but Amar, you only deal with people in California, right?
No, I have clients everywhere. Boston, Baltimore, Seattle. So I mean, I'm FCC registered, so I can work in all the states. So.
And that's so what I would suggest, guys, is go to and I'll put all the links to your stuff there. Clientfirstcap.com, and you can get a gauge of Amar and see what he's doing. Amar is not going to. It's going to sound, but he doesn't. What Amar is trying to do is be that person for a select few group of people, and that means or a select few people. That means he's not going to have 1,000 people. He's not going to have some guy just putting $100 a month into an account. He can't. Because he's going to dedicate his time to the people who pay him the fee. Generally, it's going to be people with 7 figures of assets. So because that, if that's something that you're looking for and you want that one-on-one service, I can't explicitly recommend it, Amar, because I'm not sure if that's considered a testimonial. In our business, folks, who knows what's going on in terms of recommendation. I can't tell. But I would say absolutely worth your time to at least look to him if this is something you're looking for, because it's a challenging endeavor for folks anymore, and I get questions all the time. Are any recommendations? And I do. I have recommendations for folks who are just starting out. My man Dustin Tibbetts over at Jazzwell. And I have folks for people who are established or looking at pretty significant net worth. That you'd be one, and one of a couple for sure. And given that you can see people anywhere in the U.S. I don't see any reason why someone wouldn't reach out to you just to have that dialogue for sure.
Yeah. And, my commitment to my clients that at least annually that we'll meet in person, but, I leverage technology, right? So I do web conference calls. I've created a client portal and all that to kind of facilitate that. But yeah, I try to meet with all my clients because I believe, that face-to-face interaction, getting knee to knee, eyeball to eyeball, really helps kind of understand what is the exact problem, like what are we trying to solve for, right? A lot of spreadsheets and other stuff later, but there's another layer to all of this, which is just the behavior. Like what are we solving for and why, and how do we keep our focus on that?
Yeah, man, I completely agree. No, right on, Amar. Hey, man, I appreciate you being on here, Amar. This is great, and like I said, I'll put links to show notes and all that, and just keep doing what you're doing. I got a feeling 5 years from now we'll see you on all the biggest talk firms talk about how wealth management has changed. How come no one called it? And they'll say, Amar called it before anyone else did.
Yeah.
All right, man.
Yeah, I don't think I'll be on any talk show. I'm very much an introvert as it is. So no public speaking. And I should mention that I don't do any advertising, any dinners. No seminars or come to a evening, get a meal type thing. I mean, those are all things that
surf and turf dinners.
No, I mean, who's paying for that? Your existing clients? Come on.
Exactly.
And so, I have a dedicated separate office that's within my property, right? So I don't even pay for office space. I mean, the reason why my fees are lower is because I've eliminated about like $100,000 worth of overhead that a typical advisor would have. Between real estate and advertising and marketing costs. I mean, yeah, so I appreciate the time.
Hey,